I'm going to talk to you a little bit about Numerai, kind of introduce the tournament, and for the people who are already familiar, there'll be some stuff at the end that you will try to find it. Well, um, so first, let's just start with a legal disclaimer. This is not investment advice, solely for informational purposes. This does not constitute an offer or solicitation of an offer or any advice to purchase any securities, financial instruments, may not be into the session. And past performance, obviously, no guarantee of results. If you want to read the full Numerai terms, there. So what is Numerai? It's a market neutral global equities hedge fund. That means it trades stocks from all over the world. About 30 markets. And market neutral means we try to be uncorrelated to the average returns of any market like S&P 500. But we also are the hardest data science tournament on the planet. So we basically run a data science tournament that sort of powers the hedge fund. And I'll explain how that works. It's also the highest paying data science tournament of the time. We've paid out over $40 million in crypto. The gold number is actually probably substantially higher now. I haven't checked in a little while. So our participants are staking and earning lots of crypto. So who am I? So I'm the chief scientist at Numerai. I was formerly a computational neuroscientist. I actually worked about a mile from here at the Allen Institute for Neuroscience until 2000. And so what is a neuroscientist doing at a hedge fund? Well, it turns out neuroscience data is very low signal noise, high dimensional, nonlinear, non-stationary, and undersampled. It's also like finance data. So it's actually, being a computational neuroscience was actually a pretty good training for doing finance. There's actually even less signal in finance days, which is hard to believe if you've never used neuroscience data. So Numerai is sort of built around the idea that there's many smart people out there doing very interesting and amazing things, and they should keep doing those interesting things, but they can also use their intelligence to help predict the stock market. And this sort of Numerai's platform that enables them to contribute their intelligence to the stock market. So how does this work? So we get out hedge fund quality data that's been cleaned, obfuscated, and we give it away for people to build models on. So the idea is you train your model and then you submit predictions daily. And you stake on your predictions with our own cryptocurrency called NMR, or Numerai. And based on how your models do, you can earn NMR and burn NMR. So you can lose money. You're actually staking your, you have to buy NMR on the markets and you stake it. And if you do well, you can earn money. If you don't do well, you can lose money. Just like in the stock market. So financial data is way smaller than it seems. So all the advances in AI that we've heard about is sort of powered by a very, very, very large data set. Financial data, you might think it's big data. It's really actually not, because we don't really care if Apple went up, because we care if Apple went up when everything else went down. And so you have this sort of like time sampling problem. So one era, say the eras of a week, is one sample. And there's just not that many weeks of history going back in time for modern markets. So we'd say we maybe have like 1,000 weeks, 1,000 samples. But we have like 2,000 features. This is terrible for machine learning. This is a very, very undersampled problem, especially given how noisy and nonlinear and non-stationary all of this. So there's a bit of art to machine learning. We have people from all over the world who are experts in various domains and applying their skills of machine learning to this problem. Given a target and some set of features, the sort of simplest model you could think build is like a linear model. And linear models can work pretty well, especially in domains of finance. They've kind of dominated quantum finance and still do to this day. But because when you have very, very noisy data, if you try to fit a very flexible model to it, you can, it just won't generalize at all. And so the sort of art is to try to fit a model that accurately captures the structure of the data while being robust to all the noise and all the non-stationarities and all the and so it's actually a very hard machine learning problem. And then our staking mechanism, which sort of establishes skin in the game, sort of lets us know that users are serious and they're high confidence in their predictions. And you're not going to bet money on just a random signal. And that's also lets us know how much to weight each user. So we can combine all the predictions and you can sort of aggregate the predictions weighted by how much they're willing to stake. And this is basically a self-correcting feedback mechanism. And currently there's like a $4.5 million plus worth of NMR stakes in the tournament. So I remember when we first hit $1 million, it was a huge deal. I was just checking last night. It was actually over $4 million. Blew my mind. So yeah, it's been incredible growth since I've been there for the last less than 5 years. So this might seem like a lot of work to keep going. So we're actually making our users submit daily. So we try to make that as easy as possible for people. We have a way you can just upload your model once you built it, and it will automatically trigger every day and submit prediction for you. We also provide other tools where you can self-host or put on using your own cloud providers or even your home computers to submit predictions every day. And once you have an account, you can look at your page like this. You get a ranking. This is one of the people near the top of the leaderboard currently. They're ranked as an expert. You can see their rank on different metrics, and their sort of cumulative scores compared to benchmarks. Our two main score metrics are MMC and correlation. Correlation is just very similar to the standard Pearson correlation. MMC is a metric called metabolic contribution. I'll get to in a little bit. But you can, you can see the amount you staked. This person has staked about 10,000 NMR, which is worth about $88,000. And you can see their total return, or the 1 year return. So they made about $33,000. At the time I joined Numerai, I was actually making more from playing the tournament than my job as a scientist at the industry. Which made it pretty. They offered me a job and made it change. But it's Sorry. So you guys want it? Yeah, you can. What's the core rank? So basically you rank on correlation. So if how you're doing on the correlation metric, and we pay people out based on their performance on both of these metrics, sort of weighted more toward dailies. And so this is our leaderboard. This is showing that we have about almost 4,000 models that people submitted. A user can submit multiple models. We like when users submit multiple models. They can try it out, multiple ideas, take how much they want in each of their ideas. But currently we have about 4,000 models, and that is over 500,000 NMR, which at the value of like $8 today is based at $4.5 million, and it's their average return of each user. So this shows our current reputation and stake values, and these scores change daily as people make new submissions and the markets move. And payouts are basically happening essentially daily, because your predictions are basically on returns over the next 20 days or so. And so it takes about 4 weeks for your predictions to resolve to get your sort of final score for each prediction. And as I said, predictions from each user are aggregated and weighted by stake to form what we call the Numerai meta model. And this is a signal that sort of powers all the trading we do. And so for us, as I mentioned, we have this concept of meta model contribution because we care about we want a diversity of predictions. Unlike like something like Kaggle, we don't just want the person with the best model. We want people who are submitting a diverse array of models, each of that contribute to a very good ensemble. Because ensembling is actually one of the most powerful ways of regularizing machine learning models. For this diversity is actually very, very important to us. So we'd rather you submit a unique model with pretty decent performance rather than a very high performing model that is basically identical to the current meta model or something similar to what everyone else is doing. So we definitely encourage creativity in solutions and thinking about problems in different ways. So the market itself is an ensemble of diverse opinions, and so we think this meta model is the best way to capture that. So what is the meta model contribution? You can sort of think of it like this. So we have a target that's like you can think of it as a vector in this like 5,000 dimensional stock space. And the stake weighted meta model, the average ball of stakes, is another vector and it has some correlation target. So a user submits a vector that is part of the stake weighted meta model, but it has its own sort of orientation with respect to the target. And so you can basically remove the part of the user vector that is explained by the meta model vector to get the neutralized user vector. And then the projection of that is onto the target is the meta model contribution. So this user is pretty close to the target, actually close to the target, and pretty far away from the stake weighted metamodel, and so they actually have a pretty high metamodel contribution. If you had a user that was closer to the stake weighted metamodel, they would get a lower score because it's contributing less useful information, and is sort of more similar. And then you could have a user that is even farther away from the target, but still pretty correlated to the meta model. But because it's actually hurting the meta model, it's either hurting the meta model, that gives it a negative meta model. Oops. Okay, so yes, this is the sort of incentive, a way we try to make our incentives align. So there are some natural incentive alignments and some parts that are hard. So the natural one is users want to make money, we want to make money. We're well aligned in that. So users want to contribute to the meta model prediction of the targets via MMC, but the targets must be in minimal modeling and reflect stock returns. That is it's possible. We have good ways of making targets that reflect stock returns. A part that is hard is that higher correlations to targets should lead to more profitable portfolios, and lower correlations to targets should lead to less profitable portfolios. That part is actually quite tricky. I spent a lot of time thinking about this Goodhart's law, which is basically when a measure becomes a target, it ceases to be a good measure. And we kind of have to almost violate this law in a sense. We want to provide a target that you optimize for and produces good portfolios. The target has to also be a good measure. And why is this hard? Well, it's hard for sort of just a variety of reasons. So something we call churn, which is just the week-to-week correlation of your prediction signal. So signals that change too quickly can't really be traded properly because we have to hold our position. Trading costs money. And so if you're trying to turn over your portfolio every week, that's going to cost you more money than you actually make. So we want the signal to be relatively stationary across time. There's also liquidity and market impact effects. So you can't buy as much as you want at every stock. So a lot of times the stocks that move the most are these very small cap stocks, but we want to buy a position in them without moving their price too much. We're trying to restrict to like say 5% of the total daily volume that we want to trade in stock, just to not move the price too much. And so we can't actually buy full positions in every stock that might have a predicted high return. There's also volatility and risk constraints. We don't necessarily want a full position in every stock that looks like it has big returns. This stock might just have a history of being very volatile and would add too much risk to the portfolio. So these constraints can make it so that a signal that has the same correlation to the target, like two signals that have the same correlation to the target, can generate portfolios with very different profitability. The correlations we're actually after here are very low. As I said, this is a very low signal noise. We're talking about correlations on the order of like 0.03, 0.04. Back when I was doing science, you would not believe these kind of correlations. You would say like, that is just bullshit. But I don't believe that. But like this is like what you kind of have to work with. These are the kind of correlations that. So we are. I mean, yeah, we'll look at the difference in correlation to like third decimal points. It's crazy. But that's kind of the world you have to live in. And it's actually very difficult to incorporate all these constraints in targets that still reflect stock returns and are minimal to model. You can imagine if you tried to just reduce the return of a stock that is hard to trade into, and you sort of now your target is this reduced thing. Well, now it's not a really good. Now your model isn't really predicting returns, and it actually becomes very hard to model, and their model's not generalized because it's actually it's much more straightforward to build a model that predicts returns rather than build a model that predicts returns subject to all these constraints. There's sort of too much for the you just don't learn sort of generalizable things. So that's what makes it sort of very difficult. So this is an example of what I was seeing. This is from a backtest. So that on the x-axis is the alpha score. This is just the value of the signal being fed to the portfolio optimizer. And the y-axis is the portfolio weight. This is actually the weight that that alpha score for that stock gets in a portfolio. This is aggregated across an entire backtest. And so what this is sort of showing is, yes, alpha score and portfolio weight are correlated, but this is super messy correlation. And you can see things with very low alpha scores, like 1 or so, or can end up with a very high portfolio weight. And that's, as I was saying, because those stocks might be very liquid and very easy to trade into. And on the other side, you'll see things with very high alpha scores, and they have almost no weight in the portfolio. And the converse is true for those. And so we're working to try to give this as give better weights to people so that they can sort of know which stocks are important, and we want to incorporate these sort of weights into our scoring functions, so that our scoring function can more accurately reflect the type of the portfolios we'll actually build from the signals people are sending. Did anyone have any questions on this? Yes.
Can you tell us more about your journey in identifying what parameters result in stock movement? Like, for example, is the stock falling very quickly or rising very quickly? Or what is, let's say, promoters' share in the company currently? How is it changing? Those kind of parameters might influence the stock price, but how has been your journey in identifying what parameters to put in into the model?
Sure. It's a great question. As I think I mentioned, the number of features, which include all these sorts of things, they include sort of technical features like the type you're talking about. They include like analyst sentiment. They include things like market cap, like debt, things about company structure. So we have like over 2,000 different features that you and so trying to give a simplistic story about what features drive stock returns is extremely tricky. And one of the kind of interesting things coming from science is when you're doing science, you're trying to usually look for like a small set of explanatory variables that you can use to predict a target, because you're assuming some sort of causal mechanism there. Finance doesn't work like that, and your features can be correlated with outcomes for a while, and then that correlation can be completely reversed. And so you kind of want anti-sparse solutions. You want models that care about all features a little bit. There's not over betting on any one feature, and this sort of helps with the non-stationarity of things. So yeah, the model, it's trying to interpret what the models care about is tricky because they kind of care about everything a little bit, and these complicated nonlinear relationships between these things. And you're trying to predict these things that have some of the more well-known causal things, or more well-known. So there's things called like factors that people have in sort of standard quant. People use these linear factors, which are can be related to like value or quality or momentum. And we try to make our things that are neutral, uncorrelated to all these sort of known factors. And so we want people to sort of uncover these complicated nonlinear relationships between things that are sort of missed by the overall markets. Yes.
Yeah, options.
We do not trade options.
Since you have the data.
We have some options data, yeah. Surprisingly not as helpful as you might think. And one of that is yeah, basically it's not, I mean, there is signal there, but it's not necessarily additive to the data we already have so far. We've spent a lot of time trying to get options data working, but it's extremely noisy and sort of short term and high. So again, like because you want signals that don't change that much, the features also can't change that much, and so options data features can be a little bit tricky to make work like that. But yeah, we have not actually been able to get options data that helpful.
Any interesting?
Sure. Yeah.
Yeah, everyone wants to trade offs.
Yeah.
So I want to understand these splits more. I know you were explaining it.
Sure.
But I think, is this going to be like available?
So yeah, we plan to actually kind of change some of our scoring functions to incorporate some of these weights. So that basically, like, imagine that your prediction is sort of multiplied by the set of weights. And then you're scored against the target, or basically just like that weighted prediction is dot product with something like returns, then given something like portfolio return. So basically just so that maybe you submitted an alpha score of 1, but because that's such a high liquidity position, it's going to get super upweighted, and so you're going to make sure you want your predictions to be right for those ones.
You mentioned somebody said 5 minutes 2,000 features.
Yeah.
It's sort of like a super set of factors for users to work with this.
So yeah, users can do whatever sort of feature selection they want. Some people have found it's actually very difficult to do feature selection in a way that generalizes. We've found. Yeah, you can find feature sets that work really well, but as soon as you look out of sample, it just like you would have been better if something else featured. Is yeah. Yes.
To add on to that, I'm wondering, evidence, headlines, how much is that part of its like, or is there a feature set for that? Because current politics and like tariffs, right? Just the word might take a stock. So it's
Sure.
like, so how does that? Yeah.
That's a great question. We're actually working on new feature sets using like LLMs right now. LLMs, we're trying to like fine tune them for a problem, and we hope to pretty soon introduce some LLM features that are based on LLM reading news and giving outputs and training the features.
So why would a hedge fund buy from you? Because there are multiple players giving similar kind of a portfolio optimizer kind of thing.
Why would who?
The hedge funds.
I mean, we are a hedge fund.
I know.
Yeah.
So are you selling this consolidated portfolio optimizer to other?
No, we do all the trading ourselves. So we have investors in our hedge fund, and we're doing the trading for them. So we have part of the company is the people doing the operation of actually trading the stocks.
So how do you benchmark your performance against another hedge fund?
Yeah, there are some websites where you can get performance. Again, it's always important to compare apples to apples. So there's something called like the Orem Market Neutral Hedge Fund Index that we compare ourselves to, which we've been doing quite well relative to. That's basically the average of a lot of different market neutral hedge funds. And you have to kind of, as I said, compare apples to apples because yeah, we are not exposed to factors. We're not exposed to beta. Different people invest in different funds for different purposes, but ours is a good sort of diversifying asset, which investors like because people like investors and always come back to us and tell us we're actually very uninformed in all the rest of their investments. That's true.
So since there doesn't seem to be like points where it's like high alpha but low portfolio weight, does that just mean you're excluding that variety of score, or you just don't have data points?
Wait. So, which are you talking about? Like
the lower right quadrant is essentially empty. I was just wondering specifically.
Oh yeah. So that's like a high alpha score basically means we think the stock is going to go up. And so you don't want to short a stock that's going to go up.
Oh, this is just for short.
So yeah, a positive portfolio weight is basically a long, and negative portfolio weight is a short. Yeah, sorry, I should have been more clear with that.
Oh,
So yeah, a positive portfolio weight. So yeah, if we predict the stock is going to go up, you want to be long in it.
oh, I thought the zero was relative, but it's absolute.
Yeah, it should be
absolute position.
Yeah, and then those are actually the real numbers. So 0.02 is basically 2% of the NAV. Yeah. So that's it for our main fund. 2%, about 2% of the NAV is basically the maximum we would put into a single position, and that's 2% out of like 600%. Could be using leverage. Yes.
How do you guys make money?
How do you make money?
Like how does Numerai?
How to make by having investors who we manage the money for, and just sort of typical hedge fund structure of getting management fees and performance fees.
How does the AI model training look like? Is it a batch processing kind of approach, or is it like online learning where the model is actively updating itself based on current performance?
So that is largely up to the users. Users can do whatever they want with the data. So we're giving out new data every week, and people can they can fit a model using all the data or data up to the recent release, or they can sort of have their data fit to a point and then sort of just benchmark it beyond that to see if they're out of match performance. Yeah, the users can do whatever they want as far as modeling.
10x is the better. So 2% of 600 is per position, right? So you don't buy more than 2% of, for example, Apple
Yes.
multiplied by 600%, right?
Well, it'd be like 2% out of 600. Like the total weight of the portfolio would add up to like 6. Like the 0.02 would and all these values would add up to 6. For instance.
And X alpha, what is it? Is like what is core? What is the 6, for example?
It's sort of just a rescale. We basically rank normalize the meta model signal and do a trick like a small transformation of it to try to make it relatively linear with respect to returns. So it's just a transformation of the signals you guys are sending us. Just like one kind of transformation.
Okay. Another question. You mentioned that options features are not particularly useful for trading stocks. Have you explored using stock features to trade options? And also, have you explored commodities?
So we are at some point, hopefully this year, looking to branch out into other things like options and commodities and whatnot, like futures market. That is something we some people internally especially are really pushing for, and it's something. But yeah, we're kind of we haven't. I mean, we're a small team. We're still trying to get everything to. We want to be happy with everything before we start like launching new tournaments and whatnot. We might. I mean, we're also thinking about even sort of more specific tournaments, like maybe a U.S. Open tournament or a Japan Open tournament or that kind of thing. That are for stocks, still for equities. But yeah, we are thinking about futures and options as well.
Thank you. I mean, yeah. So I had a question. These are real world stocks, right? Not Bitcoin. NMR is the only token for staking that you
Yes, NMR is the only token.
So the question I had is, so how far do you think algo trading causes haywire in the correlation system? Because today what's happening is because almost bigger players are all in quant trading or Renaissance based, neuroscience again.
Yeah.
So these things makes an entire industry go down together, even though one of them is having better fundamentals. So
Yeah.
if I go and do a DD or a TA or like due diligence for a certain car company, and I know it's doing good, but because of the bot trading, the entire automobile index goes down. So the correlation is very high with no variance for that same group. So how does that play with your
we try to be neutral to so some of the factors we try to be neutral for are also things like industries. So we try to be uncorrelated to any specific industry. So we're looking all for like stock specific alpha. We want this sort of relative. We care about the relative performance of stocks. So as we were saying, to be neutral to like the auto industry, we would want to long the things that are going down the least and short things that are going down the most, and that would still be like a profitable trade while still being neutral to the overall industry.
No, within the industry, what I'm saying is it's just full correlation at this point. Like if you're just looking at storage companies, or quantum companies, quantum computing companies, they all go down together. They all come up together. There's just no individual player, so this correlation is very high.
It is, yeah. Quant is always hard. Yeah, it's hard. It's a game of small differences. So you don't have to be right about every single thing. You're trying to be right about like 53% of things. Yeah.
So can I just leave the question for later because we're lunchtime, and also I want to talk about this one. So sorry about that. Please go on.
That is basically the end of the talk. So.
So, I'm not trying to your wisdom, but at the same point of time, what has been the journey from, what you see as a chief scientific side of that? In the last, say, 6 to 8 months, what do you see has been the content? I know the scorecards will keep changing.
Yeah.
Those kind of things will be done. What has been the biggest contribution from your perspective? I'm not writing your appraisal or assessing yours, but at the same point of time, trying to assess the job that you have or the challenge that what keeps you awake at night?
What keeps that's a good question. As you like, I mean, what is risk? Risk is sort of large movements of things that are correlated in ways they haven't been correlated before. So when things move together in ways they haven't before and in large ways, that is a risk that is very hard to account for and model in quant. And so, yeah, I mean, that is always the biggest risk to any sort of fund. And so I mean, in a way, the only real way to do that is just to not have any like too large a position or too large a bet in any one direction. This is one thing that we've learned in running this hedge fund is that like it's better to maybe make less return on average and almost never go down rather than make more return and occasionally have a bad year. It's not investors are not necessarily rational in that sense. And that like their overall investment, if they were to stay invested for like 5 years, would be higher. But people really don't like losing money, and get really scared. And people always withdraw at like the minimum. And so just running the business, we've learned that you have to be more risk averse than maybe makes sense. We also learned that incentives for people for participants are tricky. People are not rational. Like any sort of like game theoretical thing you think people should be do, they don't do that. And so these are things that like any sort of theory you have for like how people should act is probably not good. Yeah.
Very difficult.
So not naturally good.
Yeah.
So how quickly the trade is, like multiple times in a day or like?
So we are currently for each fund, we trade only once a week, but we're actually currently in the process of moving that to every day, because we can potentially get more liquidity that way. But we have some like separately managed accounts and whatnot, and so we trade those on different days. But each fund basically right now only trades once a week, so it's a fairly slow trading cadence. But our signals are on like a month-long time horizon.
But these are paper trading, right?
No, we're trading about $1 billion a month in trades.
Has the trading changed from now? We used to have a weekly tournament.
Yeah.
We used to do weekly rounds, and now we went to days.
Yeah.
And a lot of the rationale for going daily is we need to trade more often. So, and that was like, I don't know, over a year ago now.
Well, so yeah, as I said,
So has the trading changed? You're still doing it once a week. Has it changed from 3 years ago when you were definitely only doing it once a week?
well, so yeah, 3 years ago we only had one fund, and now we essentially have 4 funds. And so those funds trade on different days. We trade a different fund Monday, Tuesday, Wednesday, Thursday, and we're using the most recent signals for each day.
Correct.
So we are actually using the daily signals for trading.
I just didn't know if it was mostly like a churn sort of anticipator for next week, you know, where it's
No, yeah, we actually are using the most up-to-date daily prediction now.
yeah, we noticed because we stopped getting information about the funds. The last we heard, there was Numerai, the
Yep.
original Numerai, there was Numerai Supreme, which we had just about to launch.
Yep.
When they had Numericon, which was like the less constrained version.
Yep.
And then, I guess you have 4 now. I think I know of another one, which is called, is it Time something or what? And we thought, we were guessing that was maybe like a private or a
So-
particular group of investors.
Yeah, so we have 2 separately, they're called SMAs, separately managed accounts. They're basically just sort of clones of like the main fund. They're just managed separately. They have their own portfolio optimization. And that's just a lot of investors don't want to invest in a commingled fund for whatever reason. They just want their account separate, but it's essentially just like a clone of Numerai Numerai 1 that trades on a different day.
So it's almost an accounting thing.
It's
It's different because
Yeah.
days, but it's almost an accounting.
yeah, and I mean they might have like a different like prime broker, so they might trade through a different bank that we have to. So there can be like yeah. I mean,
Is there anything other insider info which we haven't heard about that you're allowed to talk about? And just fill it.
It'd be, I mean, I could answer specific questions. I can't, yeah.
Anything interesting in the works? I don't know.
I mean, some of the new, some of the new payout weighting. I've been working on the neutralization matrices where basically every signal will be neutralized by just multiplying by a matrix that we can give you, and so you can even train through these matrices. So that just ensures that the signals you guys are giving us are uncorrelated to whatever we want them to be uncorrelated.
On these weights, so you're talking about certain stocks being weighted more.
Yeah.
So that would mean everybody's signal for that would be upweighted.
Yeah.
In other words, it's sort of guaranteeing a certain stock is in everyone's tail, and it's always going to count for that, because a lot of times you might just have it in the vast middle where you're not really thinking.
Yeah.
So certain stocks will just be important all the time.
Yeah, and that's kind of the reality of it is like certain stocks that are very liquid. It's more important for you to get those predictions right because they will end up in our portfolio.
Do you foresee that those weights are then relatively static? Just like the big chips stay that way forever?
Some of them will be, but yeah, those weights will probably they're going to be a function of this. One thing that I've been working on recently is trying to come up with weighting function. Is that basically a function of volatility and liquidity. So basically, we're trying to. It's a simple function to try to approximate how the optimizer will take an alpha score and turn it into a portfolio weight.
Will you give out historic weights and
Yes.
for each era?
Yep. We're still kind of there's a bit of we probably will bin them to keep obfuscation. This is another tricky part about the problem is we can't give out data that is sort of identifiable different stocks just due to licensing and things. And so we have to obfuscate things so people can't easily just map stocks with like names to weights and whatnot, especially if we're giving out similar weights in like signal to end class.
Is that only communications and stuff, or is it you also less in crypto?
So we actually have a crypto tournament too. We don't do any trading with it. If anyone does trade crypto, I would encourage you to check the crypto tournament. And people are submitting models, and actually the crypto meta model is doing quite well. It has very, very high correlation. And so I would not trade against it.
And just
What's that?
And it's public.
And it's public, yeah. It's
Giving away the crypto.
and see which crypto.
And people have made money just trading crypto meta model. So that's just we've done that just sort of for fun and for the community, but we're not actually trading crypto. Yeah. I don't know. Like it's with the newer regulatory regime, maybe that's more likely than it was before.
I'm curious, so because you're market neutral, the US market versus that market or the market case of differently. So are those signals accounted for with the model certainty, or is that what you're assuming?
What do you? We try to be neutral. We try to be like neutral to countries and whatnot as well. So we're trying to be neutral to pretty uncorrelated to countries and regions. All of those things are accounted for as well as we can.
But the banks still taking the information of the second analysis on other markets. All of this and model starts with just the Tokyo Exchange, and they follow like that. The Hong Kong, the Singapore market. So by the time US market opens, it already has like 16 hours of data for that day in terms of sentiment analysis from a global geopolitical macro point.
Yeah, and like for the signals tournament, we have a tournament. We have basically the two tournaments. We have the tournament I was talking about here. Our main tournament where we give out data, and people build their machine learning models. We have another tournament where people can use whatever data they want and submit whatever signals they want on the cross-site universe. And so that's called our signals tournament, and you can basically submit whatever signals you want with that. It's been hard for us to monetize that. Often signals people submit are very factor exposed. It's can be tricky to actually like build yourself model signals that aren't factor exposed. And so the neutral matrix stuff I was talking about, where you can basically just multiply your signal by the matrix and it removes all the exposures. That will be coming to the signal to remove first.
So for people that use like Think or Swim or something like that, they can like play around with like play money. Is there any interest or is there any thought to like have like people that just want to play around and not actually risk real money and use your platform?
Well, so you can submit models and not stake. Yeah, you don't have to stake. You can have a stake of 0 and you will not lose money, but you will still get your scores every week. And so you can, I encourage you, especially you can submit multiple models, and so you can submit like a variety of models and start seeing how they do and see what actually seems to work. And start staking on ones that you feel more confident in.
Nice. Okay.
How do you stop people from taking that and going and doing their own analysis because they're buying IP out of you?
Well, so the data is obfuscated, so you don't actually know what stock you're predicting on. You don't know how to map from tickers to the data, and yeah, the signals that come out of it are like not necessarily that useful because they're about building a global equities portfolio, and trading global equities for like an individual person is not necessarily easy to do.
So, a general question, I started doing signals recently because, well, I didn't have my own data and didn't want to get it, but you guys have, recently put out a small features of signals, which is actually, like, making a pretty decent model out of only 22 features or whatever. But I started thinking more about the actual stocks before it was just black box number fund. But I was thinking, are there features that are left out essentially because they're impossible to line up? In other words, if you got a Japan market or a Hong Kong market, an American market, are there features that just don't mesh? I mean, is it like relative? Something as an age is like a relative in Japan, but how do you mesh that with different countries to get a constant feature?
Yeah, so we do a lot of transformations of base features. One sort of typical way of transforming base features and sort of equalize them across different things is like just ranking them within like countries or within sectors. And so a lot of the features you see that are very correlated to each other are basically like the same feature ranked in different ways.
Right. So a raw value in Korea might actually be way different from a raw value in America, but the relative ranking would be the same, so they'd be about the same in our data set.
Yeah,
Something like that. Are there features that you just can't do though because they're only in Korea or something?
Oh yeah, there are actually a lot. There's like it's more common that there's like US only features, which is much better data in the US than in most markets. And so
maybe when we get that US only term, it'll be different.
yeah, that's one reason. I mean, so there are a lot of nans in the data set, and we basically just fill them for you, and you're not even aware they're there. It doesn't hurt that much to do it, surprisingly. I mean, the SNR is so low that you can just fill nans, and it doesn't hurt the models that much. But and we have when we build internal models, we can build models that are can treat nans more properly. But yeah, it's not a huge advantage to do so, surprisingly.
Yeah, question regarding your token and its value. Do you find that when it's a higher value, I think it was like $54 last year, that you got more stakers involved, or is it more of an indirect?
There is like when the token is going up, we definitely get an inflow of Degen people into the community, into like the forum, asking like silly questions. Yeah, the tournament has been, I'm sure, witnessed that. But presumably there's some conversion to good users as well. So it's always I still have a lot of NMR. I'm happy with the but it doesn't, as far as I can tell, it's mostly correlated to overall crypto markets and Ethereum.
So general interest.
Yeah, than like any other things.
Two questions. First one is, anything to do with stocks, it is difficult to look at a geography from a lens that it's just US or it's just Japan or it's just South Korea because I was like, for example, if Fed increases the interest rate in US, the stock market in an emerging market might also fall because most of the money over there comes from the US. So how do you factor in these points while you are analyzing? Because it's a huge universe of what can impact.
Yeah. So the sort of the sort of standard risk management thing for is you have these like correlation or the variance matrices between all the stocks, and often you're working in kind of a reduced set of it, like a factor variance matrix, where you're just looking at the variance of different factors. You have like your projections for each stock onto each factor. So yeah, but there is factors don't explain that much of the variance. There's a lot of stocks. There's what we also call like specific risk or specific variance, which is just like the variance of stock returns that is not explained by factors, and that's actually most of the variance. One thing I'm working right now is basically trying to improve improve our risk models by actually trying to account for more of the correlations that are left out in sort of standard factor models, and also maybe on a shorter time scale, like there might be correlations that emerge more quickly than are accounted for by standard factor models.
You had the like people who is that participate without like how do you sort of account for like quantity of these models, right? Like people who just like
Sure.
back and
Well, so yeah, basically the meta model is stake weighted. So people who stake a lot, that have a much higher weight in the meta model. So someone who stakes zero, basically almost no weight. It's actually the distribution is very like Pareto distributed. There's some people who are very very high stakers, and there's definitely some people we wish would stake more. Someone who doesn't stake has no impact.
like even compared with like cases where like people have staked a lot of it with more and it's not as
Yes, yeah, that happens, and that's a kind of self-correcting mechanism because like people don't like losing money and will withdraw their stake after they've lost money often.
But as you were saying before, they don't necessarily dislike it as much as you wish they would, as fast as they would at the stage. That was sort of the problem they had last year.
Yes.
They're limited now, right? So we've got big whales that are like 10% of the pool or something, but their meta model weight, I think, is capped at 1% now or something like that.
I'd have to check. I don't remember. Yeah.
That's public information. So.
Yes. I don't recall off my head.
I think Richard said 1%.
Okay.
Because I was surprised he even under the number. That was a while ago. It could have changed.
Yeah.
also like the way like something like this like just
Yeah. Yeah, there's multiple ways people can submit their models. So we have a system where you can basically just upload your Pickle file and then you're done. It will automatically submit for you we have tooling where you can basically set up your own AWS instance or whatnot, and it will submit for you we don't look at people's models, but we technically could because we have a Pickle file. But yeah, if you were uncomfortable with that, you can have your own setup that automatically submits for you.
and then like if let's say we have to like train just like sum it up.
Yep.
We are having another Numerai panel later with all of us council and if Michael's still around, so.
Yeah, I'll be right.
Do a lot more questions later.
Thank you.
Thank you, Michael.
Thank you, Mike. I wanted to get something on this or next time. Definitely, you guys.
Yeah, sure.